You are 3 spreadsheets deep into a property comparison when the market opens. It is 9:31 a.m. on a Tuesday in February, and you are sitting at your kitchen table in the house you bought 6 years ago, the one that appreciated 40% since then, and you are deciding whether to pull equity out to fund a rental in another city. The spreadsheets are color-coded. You have been doing this kind of thing, this careful, methodical accumulation since you were 24 and your first paycheck landed in an account that already had a brokerage attached to it because someone at your first job told you to open one before you even knew what it was for. You are not a professional trader. You have never worked a floor or a desk at a bank. What you are is someone who paid attention for 11 years, who read the right books slowly and then read them again, who made small mistakes early and learned from them before the stakes were high enough to matter. Your portfolio sits at around $420,000 this morning, diversified the way people say you should be, but never quite are, with the heaviest weight in technology and consumer discretionary, because you believed in those sectors, and you were right for long enough that the belief calcified into conviction. You close the property spreadsheets and open your brokerage app out of habit, the way other people check social media. The number at the top is down 1.2%. 2% from yesterday's close. You note it, feel nothing particular, and go back to the kitchen to make coffee. This is what experience gives you, the ability to see a red number and not feel it in your chest. You have trained that response out of yourself over years of watching positions move against you and learning that panic is a tax you pay on top of every loss. You are back at the table by 9:52 when your phone buzzes with a news alert. You glance at it. A major European bank has suspended trading in its own shares. You read it again. Then you open a financial news tab, and the headline is already multiplying. 3 versions of the same story, each one slightly more alarmed than the last. You feel the first small tightening, the way your attention sharpens when something real is happening. You check your brokerage, down 2.1% now in 20 minutes. You do not panic, but you open a second tab. The next hour teaches you something about how fast a narrative can change. By 11 a.m., the story has moved from 1 European bank to 3, and there's language being used in the financial press that you have only seen twice before in your adult life. Words like contagion and liquidity crisis and systemic. You have seen these words. You know what they presage. You were 21 during the first time and lost nothing because you owned nothing. You were 31 during the second time and lost $60,000 on paper before holding through and recovering most of it over 18 months. You are 35 now and you have $420,000 in the market, and you are watching it become $386,000 in real time. The decision you face is not whether to sell. The decision is whether what you are seeing is a genuine structural break or a sharp correction that will recover within days. These look identical from the inside. Every real crash has felt at its beginning like something that might reverse, and every sharp correction has felt at its beginning like the start of something catastrophic. The only difference is what comes after, and you do not know what comes after. Nobody does. At 11 in the morning on the day it starts, you sit with that uncertainty for 11 minutes. You watch the number fall to $391,000. You feel the tightening move from your attention into your throat. You do not have a trading strategy written down. Most people don't, even people who should. What you have is a set of rules you have internalized over years, rules that exist specifically to override the part of your brain that is now activating, the part that is calculating loss and generating urgency and telling you that doing something is better than doing nothing. The first rule is that you do not make major allocation decisions while the market is actively falling. The second rule is that you do not sell positions you intend to hold for 10 years based on one morning's movement. The third rule, the one that has cost you the most to learn, is that the story you tell yourself about why you are trading is usually wrong. You think you are being strategic. You are usually being afraid. You close the brokerage app. You open it again 30 seconds later. $384,000. You think about your father, who kept his money in savings accounts his entire life and never made anything on it, but also never lost anything on it. And you think about how you spent years being frustrated by that conservatism and how right now it does not seem like the wrong choice. Then you think about compounding, about the decade of returns that built this number from the initial 40,000 you started with, and you understand that the person who sold at the first sign of a crisis is not the person who built this account. That person stayed in. That person has been tested before. You tell yourself this the way you would tell it to someone else, because the distance helps. By noon, you have made your first decision. You will not sell your long-term positions. You will not touch the index funds, the individual equities you have held for more than 3 years, the positions that represent your thesis for the next decade. What you will do is look at the short-term trades you opened in the last 60 days, 4 positions, total exposure of around $41,000, and evaluate each one as if you were evaluating someone else's book. You write them down on paper. Old habit. The screen makes everything feel urgent. The paper slows you down. The first is a technology company you bought because of a product launch that has not yet happened. The thesis is intact, but the position is down 9% this morning, and if the market continues falling, it will absorb more damage before any catalyst arrives. You circle it. The second is a consumer brand you bought because of international expansion into a market you follow closely. The thesis is intact, and the position is only down 3% because consumer spending is holding up slightly. Staples are holding better than everything else. You leave it alone. The third is a speculative position in a company you bought because someone whose judgment you respect made a public case for it. This was always the weakest position in your book. It is down 14%. You draw a line through it. The fourth is a sector ETF you bought as a hedge against the very kind of volatility you are now experiencing, and it is currently up 6%, which means it is doing exactly what it was supposed to do. You are not as exposed as you felt 20 minutes ago. This is the thing about sitting down and writing it out. The feeling of crisis is uniform and total, but the reality is granular. Not everything is failing equally. Not every position requires the same response. The work of the next several hours is not to react to the aggregate number, but to think clearly about each component, to ask what has changed about the underlying thesis versus what has changed about the price, and to understand that these are different questions. At 12:40, you sell the speculative position. You take the loss. It is $5,700, which is real money and hurts in a specific way. But the position was always the weakest, and the thesis was always borrowed. You do not need to borrow someone else's conviction during a crisis. The market has now fallen 7.3% from yesterday's close. Your account shows $368,000. You have lost $52,000 on paper since this morning, and you have locked in one actual loss of $5,700. You let yourself feel the weight of that number for exactly as long as it takes to feel it, and then you open a fresh tab and begin reading everything you can find about what is actually happening in Europe. This is the part they do not tell you about trading during a crash. The quality of your information matters more than the speed of your decisions. The people who blow up their accounts during market crisis are not usually people who acted too slowly. They are people who acted on incomplete information at high speed, who responded to the headline rather than the structure beneath it, who sold the wrong thing for the right reason or the right thing for the wrong reason. You have done both. You have learned from both. What you are trying to do now is neither. You spend 90 minutes reading primary sources, not news aggregators, not financial Twitter, not the commentary layer that sits on top of the actual events and inflames everything it touches. You read central bank statements. You read the suspended trading notices directly. You read 2 analyst notes from institutions you have followed long enough to know whose work is rigorous and whose is performance. By 2:15, you have a clearer picture. The issue is real. It involves leverage in a specific corner of the European bond market. It is connected to regulatory changes from 6 months ago that created an incentive structure that is now unwinding badly. And the contagion risk to American equities is real, but likely overstated by the speed and volume of the initial reaction. This is your read. You could be wrong. You are frequently wrong about the macro picture. What you are better at, what you have spent 11 years getting better at, is sizing your exposure to match your conviction, so that when you are wrong in a way you can recover from, and when you are right in a way that compounds. Your conviction level on the European contagion story is moderate,
not high. You believe it is probably overstated, but you hold that belief loosely with appropriate uncertainty. The right response to moderate conviction is moderate action. You do not double down, you do not add exposure, you do not go to cash. You hold, you watch, you continue reading. At 3, the market has partially recovered. The afternoon session is climbing. Your account is back to 381,000. You have not done anything since selling the speculative position at noon, and not doing anything has been the correct choice. You feel the relief of that, but you also notice the relief and try to be suspicious of it, because the feeling of having been right is the most dangerous feeling in investing. It makes you confident at exactly the moment you should be careful. The market closes at 4 with the major indices down 4.8%. Your account ends the day at 377,000. You have lost $43,000 in one day, net of the one position you sold. That number is larger than your first year's salary. You sit with that for a long time. You do not sleep easily. This is honest. You wake at 2 in the morning and your first thought is the number, and you lie in the dark doing the math that you have already done, trying to find an error in the arithmetic that would make it smaller, and there is no error. You made $377,000. You did it carefully. You did it 11 years. You lost 11.5% of it in one day, and you held through most of it deliberately. And the question that the 2 a.m. brain asks is whether the deliberateness was wisdom, or whether it was the kind of story you tell yourself to make inaction feel like strategy. You get up, you do not open the brokerage, you write down on the same paper from the afternoon the reasons you held. You write them as arguments, not justifications. The distinction matters. Arguments engage with the counter-evidence, justifications avoid it. You write the case for having held, and then you write the strongest version of the case for having sold, and you try to judge them honestly. And after 40 minutes, you conclude that holding was the right call given what you knew at each decision point, and that the outcome tomorrow or next week will not change that assessment. This is something you have had to learn slowly, that a good decision can produce a bad outcome, and a bad decision can produce a good outcome, and the only thing you control is the quality of the process. The market will do what it does. You can only control whether you are thinking clearly when you respond to it. The next morning, the futures are up. European central banks have issued a joint statement. 2 of the affected institutions have disclosed the full extent of their exposure, which is significant but bounded. There is a floor visible now that there wasn't yesterday. You read the statement twice. You open your brokerage. The account opens the day at 389,000, already recovering before you have had coffee. You feel the pull to buy. This is the other side of panic.
Euphoria, the urge to add exposure when the bleeding seems to stop, to reach for the recovery. You have made this mistake before. You bought in October 2020 on the way down during a volatility spike and were right. And you bought in the early part of a correction in 2022 and were wrong. And the two experiences sit next to each other in your memory as a reminder that market pattern recognition is treacherous because markets repeat the shape of things but not the substance. You do not buy, you watch. The account reaches $394,000 by noon. On the third day, the crisis has a name. The financial press has settled on a phrase for it, and that phrase is everywhere, which means it has moved from emergency to narrative. And that transition matters because narrative is what the market prices, not facts. The facts have not changed significantly since day one. The exposure is what it is. The central bank response is what it is. But the story has been processed, and processed stories become manageable. You have watched this happen before. The thing that seemed to threaten everything becomes the thing that was contained. The containment gets priced in. The market moves on. By the end of the week, your account is at $398,000. You have recovered most of the loss. You have not recovered all of it, and you will sit with that gap for a while. The distance between where you were on Monday morning and where you are on Friday afternoon. $22,000. Not nothing. But you think about the technology position, the one you kept because the thesis was intact. You think about the consumer brand ETF. You think about the hedge that went up while everything else went down.
the one you bought not because you predicted this specific crisis, but because you knew that volatility would come eventually and you wanted some exposure to it. You think about the speculative position you sold at noon on day one, the one that continued falling for 3 more days and would now represent a loss of 40% instead of 14%. And you feel something that is not quite satisfaction, but is adjacent to it, the feeling of having made the right call at a decision point, even when the overall situation was outside your control. You have not won anything. You have not beaten the market or outsmarted a crisis or demonstrated some particular genius. What you have done is not blow up. You have held what deserved to be held, sold what deserved to be sold, read what needed to be read, and stayed off the phone when staying off the phone was the correct action. These are not dramatic things. They are the things that distinguish the people who survive market crises from the people who don't, and they are almost entirely unglamorous. Over the next 3 weeks, the market recovers further. Your account crosses back through $400,000 on a Thursday afternoon, and you notice it the way you notice a milestone you did not let yourself hope for too explicitly. It reaches $408,000 by the end of the month. You have not fully recovered to where you started. The technology position is still underwater, but the direction is clear and the thesis remains intact, and you are still in it. You revisit the property spreadsheets. The rental opportunity is still there. The numbers still work. You decide to wait another quarter before pulling equity, not because the market crisis has changed the fundamental math, but because you want more cash buffer in place before you add the complexity of leverage to your book. This is a lesson you have learned, or are still in the process of learning, that every decision you make is connected to every other decision, that liquidity in one place affects your ability to be patient in another, that the portfolio is a system, and systems require maintenance, not just optimization. You are not finished. You are never finished. The account will fall again. Not today, probably not this month, but eventually, because that is what markets do, and you have accepted that and built a life around the acceptance rather than around the illusion of avoiding it. The next crisis will look different. It will have a different name and a different mechanism, and it will feel from the inside like something unprecedented, because every crisis feels unprecedented from the inside. You will be older then, and you will have more capital at risk, and the losses will be larger in absolute terms, and the psychological weight of them will be correspondingly heavier. You sit at the kitchen table with the spreadsheets, the property in the other city, the account balance in the corner of your screen, the position you have held for 3 weeks through a crisis and a recovery, the position that is still teaching you something about the difference between conviction and stubbornness, about where that line is and how you know when you have crossed it. You do not know yet whether you held that technology position out of discipline or out of ego. You will know later when you have more information, and even then you will not be entirely sure. This is the condition, not certainty, not control, not the ability to see what comes next, only the ability to make the best decision you can with what you have, to record your reasoning so you can evaluate it honestly afterward, to sit in the discomfort of not knowing without letting the discomfort make your decisions for you. The market is open again tomorrow. The number at the top of your screen will move. You will watch it move, and you will feel what you feel, and you will try to think clearly. Anyway, you close the laptop. You open it again.